Welcome back, Wealth Tubers. As the presidential election approaches, the economy is at the forefront of the debate. Today, we'll compare the economic records of former President Donald Trump and the Biden-Harris administration, examining job growth, stock market performance, inflation, and consumer sentiment. With both sides touting their successes, let's sift through the data to uncover the truth. Join us as we break down the Trump versus Biden-Harris economy and what it means for your future. Don't forget to subscribe for all things wealth and economy. Let's dive in. The U.S. presidential election is almost upon us. Yet, neither candidate, Democratic Vice President Kamala Harris or former Republican President Donald Trump, looks to have a commanding lead in the polls. If voters can agree on anything, it's that the economy is a top concern in this year's contentious race. It is debatable whether any sitting president or vice president can exert much control over an economy as large and complex as that of the U.S. Yet, both candidates are running on their respective administrations' economic records, so let's have a closer look. The U.S. economy largely ran smoothly under Trump's presidency until the COVID-19 pandemic hit the U.S. in February 2020, his final year in office. At that point, the job market all but collapsed, national gross domestic product plummeted, and the stock market sank. After a couple of quickly orchestrated federal stimulus packages, the economy then rebounded, although the national debt ballooned. While Harris wasn't America's chief executive, she has largely taken on President Joe Biden's economic record as her own. It is a fairly good one, due in large part to COVID recovery tailwinds. Jobs are plentiful and wages have risen in recent years, but so has the debt and inflation. The following examine trends for 10 different elements of the economy during both the Trump and Biden-Harris administrations. The analysis compared the identical time frame for each president, beginning with Inauguration Day and continuing through September of their fourth year in office, or the latest month for which data were available. As we transition into our analysis, let's focus on one of the most critical aspects of the economy:
economic growth.
Real gross domestic product, or GDP adjusted for inflation, is a foundational measure of economic performance. Both the Trump and Biden-Harris administrations oversaw periods of GDP strength. During his first presidential race, in 2016, Trump campaigned on his ability to boost GDP growth dramatically after years of anemic performance following the financial crisis of 2008 to 2009. While he delivered only 2 quarters of outsized GDP growth above 4%, the Trump economy mostly grew by a healthy 2% to 3% a year, at least until the arrival of COVID. Then, GDP fell by a historic 28% in the second quarter of 2020, Trump's last year in office, as consumers entered lockdown and businesses closed their doors. Real GDP rebounded in the period from Biden's inauguration in January 2021 through June 2022, growing by an average of about 3% a year. Much of the credit owed to billions of dollars in federal stimulus payments that supercharged consumer spending. Still, GDP grew by 2.5% last year, after much of the recovery bounce arguably had dissipated. And after a slow start to this year, second quarter GDP growth measured 3%. The New York Federal Reserve staff nowcast currently estimates third quarter GDP growth of 3.1%. Next, we will explore another vital indicator of economic health:
Stock market performance.
Investors have done well under both the Trump and Biden-Harris administrations. A strong stock market has helped them build wealth, which encourages consumer and business spending and helps drive economic growth. Stocks rose 48.1% under Trump in the period measured, and 49.6% under Biden and Harris in the comparable span. Yet, the market stumbled in the second year of each administration due to rising interest rates, a government shutdown, and trade friction with China in Trump's case, and the rise in inflation and interest rates under Biden-Harris. Year 3 was the best for each administration. The benchmark index returned 31.5%, including dividends, in 2019, the third year of Trump's term, driven by a combination of ultra-low interest rates, billions of dollars in stimulus payments, and the reopening of the economy after the introduction of COVID vaccines. The S&P 500 returned 26.3% in 2023, the third year of the Biden-Harris administration, as investors embraced mega-cap technology companies tied to the burgeoning business of artificial intelligence and celebrated the Federal Reserve's pivot to lower interest rates. Now, let's turn our attention to a critical issue affecting consumers and businesses alike.
Inflation.
Americans enjoyed relatively low inflation while Trump was in office, a continuation of the historically low levels of the Obama years. Consumer price growth peaked at 2.9% on an annual basis in June 2018, and subsequently fell to a low of 0.2% year-over-year in May 2020 as COVID lockdowns took effect. Inflation's resurgence is the biggest economic story of the Biden-Harris years. The COVID pandemic and the government's response to it supercharged price growth, with supply chain snarls, stimulus spending, geopolitical pressures, and pent-up demand all pushing prices sharply higher. The Consumer Price Index hit a peak of nearly 9% year-to-year in June 2022, the second year of the Biden-Harris term. Inflation has since cooled to 2.4% based on September's CPI reading. Most supply chains have normalized, while the Federal Reserve's aggressive rate hike campaign has helped to bring down price growth. Still, inflation has cumulatively increased by nearly 20% during Biden's presidency, and many Americans are grappling with its debilitating effects. At this point, let's take a look at an essential part of the economy.
Employment.
Presidents like to tout job growth under their leadership, but measuring their direct impact can be challenging. Trump's main legislative win in a gridlocked Congress was the 2017 Tax Cuts and Jobs Act. While stimulative, economists say it didn't create as many jobs as promised. Biden and Harris had several legislative wins that produced job growth, including the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, and the CHIPS and Science Act. But they can't claim all the credit, as these were bipartisan efforts. By the numbers, the economy added 6.8 million jobs during Trump's first 3 years in office, before the arrival of COVID. It then lost 9.8 million jobs in 2020, producing a net loss for his term. Yet, even if the first 3 years' growth had been annualized over Trump's full 4 years, job growth during his administration would have lagged behind that seen under Biden and Harris. The U.S. added 16.4 million jobs during the Biden-Harris years, through September. But with the pandemic recovery waning and higher rates constraining growth, the economy has added just over 200,000 jobs a month this year, well below the growth seen earlier in their term. As we continue our exploration of key economic indicators, let's turn our focus to an important factor that affects workers and families.
Wages.
Americans' ability to spend usually informs their view of the economy. It's no surprise, then, that many Americans feel they did better under Trump. Wage gains were low, but so was inflation. Average hourly earnings, adjusted for inflation, rose 6.4% during Trump's term. While a tight labor market delivered significant wage gains for most Americans in recent years, and particularly lower-income households, high inflation during the Biden-Harris era restricted purchasing power. Workers saw real wage gains of only 1.4% from January 2021 through September 2024. Indeed, there were times during Biden and Harris's tenure when wages didn't keep pace with inflation, particularly when price growth accelerated in 2022.
Unemployment.
The Trump and Biden-Harris teams can both take a victory lap on employment. Both presided over strong labor markets, minus the pandemic years. Another measure of labor conditions is the unemployment rate, which declined during both administrations. The unemployment rate fell from 4.7% in January 2017, on the eve of Trump's term, to 3.5% in September 2019, a then 50-year low. Trump was handed a strong economy by the Obama White House, and it got even stronger. Also, some components of his corporate income tax cuts spurred business investment. Alas, the pandemic put an end to the good times, at least temporarily. Unemployment spiked above 14% as COVID took the U.S. economy hostage. The unemployment rate was still elevated, at 6.4%, when Biden and Harris took office in January 2021. But it had fallen to 3.4% by April 2023 as the pandemic crisis eased and the economy reopened. In the past year, labor conditions began to normalize, a consequence of both COVID tailwinds fading and higher interest rates. The unemployment rate climbed to 4.3% in July, triggering a recession indicator, but backed down to 4.1% by September. Let's take a moment to examine a key element that impacts financial decisions.
Interest rates.
There were a few parallels during the Trump and Biden-Harris administrations in the trajectory of interest rates, but there were no similarities in the magnitude of moves. The Federal Reserve raised its benchmark federal funds rate in quarter-point increments during the first half of Trump's presidency to a maximum targeted range of 2.25% to 2.5% in December 2018. Trump criticized the higher rates repeatedly. The Fed began cutting rates in July 2019 and dropped them to an ultra-low range of 0% to 0.25% during an emergency meeting in March 2020 when the COVID pandemic took hold. The Biden-Harris era was marked by rate hikes, 11 in a two-year period, to a targeted range of 5.25%-5.50% as the Fed sought to get surging inflation under control. The central bank held rates at that level for more than a year before recently implementing a rate cut, lowering the Fed funds rate by half a percentage point to 4.75% to 5.00%. According to their latest summary of economic projections, Fed policymakers have penciled in another 2/4 percentage point cuts in for the rest of 2024. Moving on, let's take a closer look at a significant factor influencing homeownership and affordability.
Housing prices.
The average home price in the U.S. was below $300,000 when Trump took office in January 2017. Today, it is $493,948, a reflection of heated demand and constrained supply. While those prices aren't adjusted for inflation, housing affordability has become a pain point for would-be buyers and communities across the country. It is now a headache for politicians, as well, with Trump and Harris both floating plans for easing the sector's logjam. The pandemic fueled a home-buying spree, with home sales reaching a 15-year high in 2021. While property values climbed during the Trump years, some of the steepest increases in the past 30 years occurred during the first 2 years of the Biden administration. Buyers who snagged low mortgage rates prospered, but rising interest rates reduced household mobility for mortgage holders by 16% in 2022 and 2023. That caused $20 billion of deadweight loss, or the cost to society that occurs when there is economic inefficiency, according to recent research from the National Bureau of Economic Research. Let's take a moment to discuss a significant factor that impacts the economy and future generations.
Public debt.
Public debt stands at $35.7 trillion today, equal to $101,958 per American, according to the latest estimates from the Peter G. Peterson Foundation. Unlike many other parts of the economy, presidents tend to have more of a direct impact on the level of the national debt. To be sure, the needs of aging baby boomers are putting stress on social programs and healthcare costs. But some of the budgets proposed by both the Trump and Biden-Harris administrations have been far from balanced. Trump added an estimated $8.4 trillion to the national debt over 10 years, including about $3.8 trillion in 2020 that included stimulus legislation to shore up the U.S. economy, according to calculations by the Committee for a Responsible Federal Budget. Trump's 2017 tax cuts alone are expected to add $2.2 trillion in debt over a 10-year period. But the Bipartisan Budget Act of 2018 and increased tariffs on steel, aluminum, and other imports saved an estimated $444 billion. Biden has added only $4.2 trillion to the national tab, largely through the American Rescue Act, pandemic-era stimulus legislation passed at the start of his presidency, according to calculations by the Committee for a Responsible Federal Budget. The Fiscal Responsibility Act and the Medicare Advantage rule, both passed last year, could save $1.3 trillion over 10 years. However, as we move forward, we'll take a look at an important measure that reflects the confidence of consumer.
Consumer sentiment.
Notwithstanding a strong job market and economy, consumers aren't pleased with economic conditions and haven't been for the past 4 years. The pandemic shook Americans' optimism, and soaring inflation damped sentiment further. Gallup's Economic Confidence Index, which tracks whether consumers believe economic conditions are improving or deteriorating, was fairly robust during the Trump years. But the Biden-Harris administration inherited a country suffering from pandemic fallout and inflation soon added to the public's woes. Even as many economic indicators improved, confidence in the trajectory of the economy has remained persistently low. As of September, Gallup's index was still registering low levels of confidence seen during recessions. Based on their economic records, both administrations have a lot to campaign on, and some issues Trump and Harris both might continue to duck. Now, it is time for both to sell Americans on their vision for the next 4 years. Thanks for watching, Wealth Tubers. We hope you found our breakdown of the Trump versus Biden-Harris economy insightful. What are your thoughts on their economic impacts? Drop your comments below. If you enjoyed the video, give it a thumbs up and don't forget to subscribe for more wealth insights. Until next time, stay informed,